I'm really happy and excited to have you on the podcast. Maybe for everyone, for a bit of context, how about you give a quick introduction so everyone knows who you are and what you do?
Yeah, sure. First of all, thanks for having me here. I really appreciate it when you were reaching out. I don't know if we're going to talk about that later, but basically, we met at university 7 years ago,
Yeah,
and never
it's been a
spoke
while.
since then. We're not really in contact, apart from seeing the great stuff that you're doing on LinkedIn.
Yeah.
So yeah, thanks for having me here. Hi everyone, I'm Nico. I'm originally Austrian, like Jürgen, but left Austria around 3 years ago, initially to pursue my master's in Paris, in France, which was an amazing time. Then from Paris, decided to move to Berlin 1.5 years ago, or a bit less than 1.5 years ago. And I work for a venture capital fund here in Berlin. They're called FoodLabs. Um, Basically, we invest in food tech companies at the earliest stage. Next to investing, we also do company building, maybe more to that later. So yeah, living here in Berlin for quite some time now. Um, what else exciting is there to talk about or to mention about myself? Probably the biggest hobby or my biggest passion, what I really love pursuing in the winter months is skiing. I guess this is very cliche Austrian. Which I mean, I did that a lot more when I was younger. Now it's quite tough with having only a limited amount of
Yeah.
holidays.
Yeah.
But yeah, I would say this is the biggest passion. I worked as a skiing instructor for a couple of years. I
Okay.
guess
It's really like a
this is
big
even
role in
popping
your.
up. Yeah,
Yeah.
absolutely.
Nice. Did you think that when you were studying at VU that you would end up working for a VC in Berlin?
No, not at all. I think that's an interesting topic. And I thought about that actually here and there, thinking back to my starting days at VU, which for people listening around the world is basically the University for Economics in Vienna, where Jürgen and I met. To be honest, back then, I think when I started my studies, I was 18, and I
Mhm.
had, I would say, relatively little clue about what I want to do in the future. I think at VU, especially in the beginning, everyone was kind of going for the very typical career, management consulting. Maybe a couple of people that were going for the finance track were looking more into investment banking or maybe private equity. But to be honest, back then I was not even really aware of many venture capital funds and what they're doing.
Yeah.
First first time I got in touch with a fund was actually through now one of my closest friends. Who was working at Speed Invest. That's a
Yeah.
venture capital fund originally from Vienna.
But it's also one of the only presence of venture capital in Austria, right? Like whole concept. I mean, apart from reading articles on, I
Mm.
don't know if I used even LinkedIn back then when I started at school. Probably not. Like, did you hear about when you read about startups, you
Mm.
eventually will run into VCs, and
Mm.
then you're like, oh, okay, those are investment companies, but there just isn't the other way around that you first get to know about VCs because the presence is just so small in Austria, I want to say, like compared to
Yeah,
the Silicon Valley, for example.
yeah, no, absolutely. I do agree. Like there is not. I mean, there's more and more funds now in Vienna, which I think
Yeah,
is great, and is also super important for the Viennese or Austrian ecosystem, where I guess there is still a long way to go to
yeah,
basically catch up with the other countries or the main countries in Europe. But yeah, absolutely. There's a limited amount of funds in Vienna or Austria.
yeah. Like so to stay with your own decision making, like you didn't really have it on your radar. What changed? Like when was it that the first time you were like, okay, VC is actually an attractive place for me to start my career?
Mhm. So as mentioned, the first time I got in touch with a venture capitalist or a venture capital fund was through one of my or back then I didn't know him much, but in the meantime we were very close friends. He worked at Speed, or he's still working at Speed Invest actually,
Mhm.
and he was moving into my apartment in Vienna during my exchange semester in Madrid.
Ah.
And that's how I kind of got in touch. And he was working a lot, so he was speaking a lot about his work as well. And it was super intriguing. And like back then, he was focusing quite a lot on fintech, and then moving more into the emerging markets direction. It was always quite interesting to listen to him.
Mhm.
So back then, I think it was the first time that I thought about doing so. But then, like between bachelor and masters, there was no point of joining a venture capital fund. Basically, I've only done a few internships in marketing and different topics before. So between my bachelor's and my master's, I was joining a management consulting company in
Mhm.
Vienna. Accenture was looking into health and public services.
Mhm.
So there I was still pretty open and not too sure what I want to do after. And then I remember even when I started my master's degree, I was still pretty sure that I'm gonna pursue this typical start of a career of someone who studied business, basically joining a big consulting company and working there for 2 years, 3 years, and then let's see, right? Like many people do it, and there's nothing
Yeah,
wrong about that.
especially if
But then
you.
through exactly, and there's nothing wrong about that. I have many friends doing that, and
Yeah,
like they all land amazing jobs after doing so, and
yeah.
some even really enjoy working there. But then throughout the master's degree, I like some of my peers in my masters, they had started companies before, they had worked or interned in venture capital
Mm,
funds before.
nice.
So I kind of got into this group of people where basically this was a topic that we would speak about on a daily basis and speak about the
Yeah.
different funds out there and how to get into one of these funds. And that was kind of like the moment where I was like, okay, I wanna go for that. That's quite exciting. Um, and then we had to do an end of master's internship,
Yeah.
and it was pretty random actually. I already had an internship secured at Gorillas, which
Mhm.
is this 10-minute grocery delivery company. Actually, one of our portfolio companies or former portfolio companies
Mhm.
in Paris. And then just before I started working for Gorillas or doing my internship for Gorillas, where I was supposed to stay for 6 months, I found this internship job posting at a French venture capital fund. They're called Partech,
Ah.
and I applied for that. And at that time, they were looking for someone with a generalist background and someone who would speak German. As mentioned, they're a French fund, but they were also investing in Germany, so they were looking
Mhm.
for someone who speaks German. So yeah, things worked out. I joined Partech after spending 3 months at Gorillas. I didn't want to
Ah,
miss
I did
out on
both.
the possibility of exactly. I worked for Gorillas for 3 months, exciting times. They were already big in Germany, but then just launched in Paris, so that was pretty
Yeah.
cool. And then joined Partech, and I was investing a bit later stage than I do now. So basically, there we were looking into companies at Series A and B stage.
Mhm.
Um, but industry agnostic. So
Mhm.
basically, one day I was looking into a health tech company, the next day I was looking into a fintech company.
Oh wow.
So
Okay.
and
Really broad.
and really broad, and that was then the moment where, on the one hand, I realized I like working in VCs was really intriguing for me, and like I really enjoyed doing so, and speaking with many founders on a daily basis, and looking into different topics, and trying to get my head around new technologies that I've never heard about before. But I was
Mm.
realizing that as a generalist with a business background, I want to focus on a specific topic in order to be able, to build knowledge or to become knowledgeable in a space.
Yeah.
And yeah, which obviously is important when working with founders and trying to make assessments on companies and whether to invest in them or not.
Yeah. Like I can see that. I mean, joining a VC, I feel like, especially people coming from business, but also if you are, if your academic track like started in a domain, let's say healthcare, for example, but you don't want to be a healthcare professional, uh, joining an investment firm that invests in that sector where you can apply this knowledge to finding right investments is also attractive for a lot of people, especially who have like
Mhm.
business acumen. But what would you say is what's
Absolutely.
like the profile, or like what are the must-haves for someone who wants to work at a VC?
I think there's not one specific profile
Hmm.
or like one right path out of university to join a venture capital fund. I think there's different ways. Um, I think the way I did it is less common way, or at least
Hmm.
used to be a less common way 5, 6, 7 years ago. Back then, you would only be able to join a venture capital fund after already having made a career somewhere else,
Hmm.
which makes sense also, obviously. Like if you've been an operator for a couple of years, started something yourself before, really know how things actually work, because obviously this
Yeah.
makes you a better investor as well. But now things changed a bit. Funds started looking for analysts. It's becoming more and more of a thing that people start out of university as well. But getting back to the main question of what's the typical profile, again, there is no typical profile. I think what we see more and more now is that there are people who do not have the classic business background.
Hmm.
Um, there's more and more people who are coming from life sciences, people with an engineering background, or people in general with more technical backgrounds. Or as you mentioned before, basically someone who maybe started a career in healthcare, then joining a fund and bringing in their knowledge. Um,
Yeah.
I think this is a phenomenon that we see more and more. Basically, people coming in with different
Mm.
backgrounds, bringing different knowledge to the table.
Yeah.
Um,
Yeah. I feel like in Europe compared to the US, so many more people are studying business. That's like, I feel like here, or I would assume here in the VCs, they don't have problem finding people from a specific domain, because a lot of schools don't even offer a major in undergrad in doing business. Like there's very rarely there's a bachelor of business. So
mm,
people do computer science, or certain things in health, or just like related topics, and then afterwards go into industry, and then like maybe
mhm,
after a couple of years, if they find a VC they're interested in, or where there's like a match,
mhm.
they already bring like domain knowledge with them. Whereas in Austria, like business schools are huge, like undergraduate programs of business schools are some of the
Yeah,
biggest programs. Like in France, like you have all those small private business schools, right, that are like focused, like so many also focus on marketing,
yeah.
and I feel like
No,
that's
I
a
agree.
different recruiting pool.
But I think that's maybe actually a lack in the European or in the Austrian system. Uh,
Mm,
as you mentioned, like there's people that in the US that already in their undergrad start something or study something super, you know, excite or not exciting, but maybe something
hard to say, right?
that's not necessarily business. Whereas in Austria, I still have the feeling um, after high school, like the majority of people would still pursue this very typical university or academic career in the beginning, basically
Mm,
either studying business or law or medicine. Now more and more philosophy, psychology, um,
yeah,
and then there are some biologists. Um, I hope I don't forget any
yeah.
big one now, but I think after that it's already fairly limited, and it's not really a common thing to do so. I think in Austria still.
I mean, like just like the programs on the one hand are not big, like in terms of like infrastructure of university, but on the other hand, also the interest in doing that right after high school.
Exactly,
Is- Yeah,
exactly. I'd say
yeah. There's this
it's both.
fear of specialization. Like at least that was something that I had, and what I found with a lot of people at undergrad, where specializing on anything, even within your business degree, was like, am I making the
Yeah.
wrong decision? Am I closing any doors? What if I change my mind afterwards? So-
Although although you made a pretty good decision, no? When going into the data science direction, basically looking at where you stand
yeah,
now, I guess you took the right turn at the right time.
yes, that was very fortunate and almost serendipical. Like
Mhm,
when I was at the end of business, or like in the last year, basically, I
mhm,
did an exchange in San Diego, and I was like, okay,
Mhm.
I don't really see myself. Like I was already at Icons at the student consultancy,
Mhm.
and I saw like what the trajectory for most ambitious people that graduate business is, and it's like either consulting or you go into banking, or you go to kind of like somewhere in between, or like specialize yourself in marketing. Okay, but like the main thing, consulting and banking, and I just didn't see that happening for myself. Or you start a startup, right? Which is great, but I didn't feel equipped for that either. So I was like, okay, I wanna have something where I can create something, which was
Mhm.
still very broad. So I was first looking into like very technical things. I was even going, I was joining a friend who studied technical physics at the TU for
Mhm.
uh, for lectures and all, like mechanical engineering. Because I was thinking, okay, I
Mhm.
want something engineering, like where I learn to think how an engineer. And worst case, I just get to support engineers from like
Mhm.
with a business knowledge from a business position, but just like bridging those two worlds. And then the like Icons has like this mentoring with alumni,
Mhm.
and I landed this alumni who had like a couple of years before me. He was like 6 years older. Also started with business, and by then he was already, I think, like right after he started running the Austrian mail service, like Österreichische Post, the data science
Mhm.
department there. And
Ah,
he was
cool.
like, "Hey, just get some data science kids. If you really want to do that, just
Mhm.
learn Python or R or whatever.
Mhm.
Oh, there's the specialization. Do that at
Mhm.
VU. That, if that interests you, that's like the perfect track. And then you can always do a data science master right after
Mhm.
at TU if I really want to do that. I didn't do the data science master, but
Mhm.
I was really engaged in that topic. And since
Mhm.
then, that's like I'm really happy that I found that at least like this, like data science is still super broad, right? It doesn't have a domain focus, but it's like
Ah.
just this toolbox of like methods that you learn. And I'm
Mhm.
really happy that I got that because it makes at least I have some footing in some worlds.
Exactly.
And that's really
Exactly.
helpful.
My master's was actually in big data and business analytics,
Ah,
um, which was super interesting. It was a business school though, so
mhm.
I learned the basics in a couple of languages. Um, but yeah, I'm not a programmer, and I also like very honestly realized back then that that coding is basically not my biggest passion. I found
Yeah,
it super interesting to learn the basics, but it was
yeah,
not something where I felt like I didn't, I wasn't too excited about sitting down and like so basically coding for a couple of
yeah.
hours in a row. But yeah, I definitely agree. It's good to have the basics, and yeah, it would have been. I would have enjoyed to learn even more. Maybe I'm gonna pick up one of these courses at some point again.
Yeah, I mean, especially when it comes to coding, I feel like the main thing is how much time you invest, so you don't necessarily need a
Yeah.
big program. That big
Yeah.
program is great for exposure, so you see like where you
Mm.
can start, like differences, like identify differences, and also know people then who
Mhm.
already went through that initial phase. So you can ask them. But I feel like people, or at least my perspective, and also the people around me, whenever like in this, you would feel like whenever we hang out with people on a business call, and then there's
Mhm.
like someone who says like, yeah, I create websites on the side, or hey, I do those projects, like I code some stuff. That was like, oh wow, that person knows Python. Oh wow, that person knows how to code. And you're like,
Uh,
ooh, you really have like no idea like the level they are. Like maybe I mean
mm.
Austria also has like this really cool system with the BMHs, like the schools
Mhm.
where you don't have like just general high school, but like specialized, like for example, on mechatronic or
Mhm.
on like computer science. And so many people come out of those schools and are really good at creating like basic applications. And that's like a huge
Sorry, just 1 second, Jürgen. I'm
reward.
really sorry to interrupt you. I need to plug in my laptop. Perfect. We got it.
All right, laptop plugged in. Uh,
Laptop plugged
so yeah,
in.
like I feel like there's this huge barrier of knowledge because you just can't imagine what it looks like when you do it yourself, that people are so hesitant of just trying it out. Because like,
Mm-hmm.
literally, you can get a free class on Udemy or pay $5 or
Mm-hmm.
just go on YouTube and do a tutorial. And within a week, you can write your first simple applications. And that already helped me so much in just understanding
Mm-hmm.
what software is, like what it
Yeah.
takes, also like from an entrepreneurial perspective to create a web app. You can look like when you go on a website, you are like, okay, that website can do this, 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 this application, this app can do this, this,
Mm-hmm.
this. That's actually not that complicated. Or, oh wow, this is super complex. And that makes it so much easier to orientate yourself in a world for like a
Yeah.
week or
That
two of
makes sense.
effort of just getting basic skills.
Cool.
Yeah.
Yeah.
It's
I mean,
like so.
I think it's, I think it's quite cool that you went that direction.
Yeah, I'm
If you
really
look at
happy
all
and
the other
proud as well.
profiles from VU, like I think I can count, I counted on one hand the amount of people that basically after university or our university, yeah, went to pursue a career in this space. At least from the people I know. Maybe it's wrong to say so, and it's not right to say so because there are other tracks but from my close circle at university, the majority pursued a career, a very typical business career.
Yeah, but also makes sense, right? Like given that you study business, you might as well
Mm,
apply that then in your professional
yeah,
setting. And also
absolutely.
for a lot of people, it also was the right fit. Like I
Yeah.
have countless of friends that ended up like in change management or in
Hmm.
marketing or go down banking consulting route and are
Hmm.
at least like look from the outside really happy and doing really well,
Yeah.
which makes me really happy because this if you I also know of enough people that went down 3 years of a bachelor and then even might have done 2 years of a master's in a specialized field like
Mm,
chemistry or mechanical engineering, and then afterwards we're like, I never want to have to do anything like want to do that ever again. And then
yeah.
it's like, okay. And then they go into consulting,
And now what?
which is, I guess,
Yeah.
is also nice, right?
Yeah.
Like then you also have at least some domain knowledge. But there's like it's
Yeah.
so hard to know which decision is the right one. I guess you can only make
Of
best
course.
guesses. But for you,
That
it worked
it's
out. Yeah.
no, I'm saying it's about figuring it out on the way, I guess. As we've been discussing before, I'm 25 now. If I'm telling my 18-year-old self that I'm going to work in venture capital, my 18-year-old
Mm.
self would probably ask myself what's exactly venture capital. Right.
Yes,
So I guess it's
exactly.
about trying different things, figuring it out on the way, and then see
Yeah.
where you end up.
No, exactly. Like some things you have to experience yourself, other things you just have to know about from a peer. It kind of has to end up on your map.
Mm,
Uh, but yeah, so now VC life, uh, FoodLabs.
yeah.
So what does your typical day look like? Like what,
Yeah.
what does working at FoodLabs entail?
Yeah. Maybe it helps if I give a bit of an introduction to Food Labs and what we do in general,
Yeah.
and then happy to dive into my day-to-day activities, which I can say are there's no day like the other. Um, yeah, briefly about the fund I work for, Food Labs. We're based in Berlin. We're an early stage venture capital fund, so we're focusing on pre-seed and seed investments. So basically, at the very early stage of a company, this can mean that there's two founders who have an amazing idea and started working on some tech, but that's basically it. This is when we try to come in as early as possible. Um, we're investing globally. The majority of our portfolio companies are based in Europe, but we've made
Mhm.
first investments in the US, in Israel, actually in Africa.
Mm.
We have not invested into an Asian company yet, but we would
Mhm.
be very open to do so.
Mhm.
As the name already implies, Food Labs, basically we're looking into everything that is somehow related to food. So we always
Yeah.
say we invest along the whole food value chain. So basically from farm level agricultural tech, everything around alternative proteins, packaging, down to post consumption.
Mhm.
I think you can kind of, or we always try to kind of cluster it into three main buckets that we look into. First one being food tech, biotech. So one of the main topics, obviously, alternative proteins. How can we get rid of the animal in the food value chain? Here we're excited about companies that are working on the end products. So basically, if you think about a whole cut uh, piece of chicken that
Hmm.
is produced without having to kill an animal before.
Hmm.
So on the one hand, the companies that are producing the final products. On the other hand, something that we're really excited about at the moment, basically B2B enabling technologies in the alternative protein space. Basically, companies that are improving processes, helping companies that are out there to scale, to reach commercial scale, to reach
Hmm.
taste and texture parity, to reach price parity with existing products. So yeah, this is about the food and biotech bucket. Another thing that I would put in there as well is alternative packaging solutions. We have a very exciting company there
Ah.
in the UK that basically figured out a way of producing an alternative to plastic made from algae.
Ah,
And yeah, by
nice.
doing so, they're I mean, happy to talk a bit more about that later. But basically, they're yeah, saving an environmental issue, but they're also saving a health issue of microplastics that are in products, and they also
Yeah.
manage to extend shelf life. So this being the first bucket, food tech, biotech. Then the second one that we look into is software and marketplaces. This can be again along the whole food value chain.
Hmm.
So this can be software that is, as I just mentioned, supporting companies working on alternative proteins, but this can, in theory, also be software that is used in restaurants. And then the
Yeah.
last bucket being consumer. So everything that is related to the consumer, big brands. We also have a good number of investments in that space. This is uh, this is pretty much the three main topics that we look into. Um, and
And
there are
uh,
a lot of different topics fall below that, obviously.
okay, okay. But like between those three buckets, is there like one of them where you put the most manpower behind, or is it like quite evenly
Mm.
distributed?
So, I mean, that's a good question. Maybe getting back to the initial part of presenting FoodLabs. So we have an investment team, which I'm part of, where we're uh, four people at the moment. We have a venture building team, so we build
Hmm.
around 5 companies from scratch every year. So
Hmm.
it's these
Wow.
two teams, and then we have a big operating team or different operational teams. This started out initially when we started with company building, because when we started out in 2016, initially we were a company builder. So back then we started yeah, with these operational teams that were there,
So when you
are
say
still there.
when you say
Sorry, yeah.
company builder, the idea is
Mhm.
that you have like one central organization with a lot of know-how, and then you dedicate teams to build a company within this overall structure and then try to grow that.
So basically, our company building team, our venture studio, is
Hmm.
4 or 5 generalists working on that full time. And
Hmm.
basically, what they do is they screen the market,
Hmm.
and they ideate on a rolling basis. They look into different topics. They're analyzing topics. Not just high level analysis, but really going deep into a topic. And
Hmm.
once they build conviction around a topic, um, and they decide to pursue that topic, then we basically start looking for what we call entrepreneur in residence. So basically, potential founders that are
Hmm.
eager to join us and to start that company together with us. So then we look for the right
Ah.
people. Um, Obviously, these topics can be super different one from another. So this can be a very biotech heavy company, but this can also be a consumer company. Basically, then we start looking for the right profiles to start this company. These
Yeah.
are not Food Labs employees. These are people that basically we look for from the outside. It's pretty much hiring a person.
Yeah.
Then bringing this person or this initial founding team, can also be more than one person, on board, and then basically they already get a high level idea of the topic, obviously, because they
Hmm.
have to understand what they're going to be working for. Then they
Hmm.
join us. They can either decide to join us in our offices in Berlin, and we're more than happy to host them here and to give them
Hmm.
a working space here. But they can also do that from wherever they're based. We're not forcing anyone to move to Berlin. And then basically, our venture building team acts as a sparring partner when it comes to ideating. For a couple of months, there is not a predefined period of time, but then basically it's about further validating a specific idea. Just start working on that, and then basically after a couple of months, there's kind of then we're taking a decision whether it makes sense to incorporate this company or not. And
Yeah.
if the decision is positive, then that basically goes in line with a pre-seed investment from FoodLabs.
Nice. So if you are an entrepreneur out there
Mhm,
interested in like generally the topic of, let's say, sustainable food,
mhm,
sustainable nutrition, but you don't have like one specific idea that you're like fully
mhm.
behind, but you just want to make progress in that field, you could
Yeah.
get in touch with VCs that are investing in this area and ask if they might have like this
Mhm,
company building structures, and then you
yeah.
it might be able for you to become the founder of an idea they have like somewhat vetted already.
Exactly. So basically, this is the best case scenario that can happen to us if there's a person out there that is eager to start something in food or climate,
Mm-hmm.
that is approaching us, that already has an idea, or maybe not even an idea, that is basically just eager to start something.
Mm-hmm.
But even better if people come with a slight idea of what they want to do. They approach us, and then we start working together with them. So it works both ways. Either we ideate, we come up with topics, and then we look for the right founders or founding team, or it's the other way around. People approach us. People are out there. They know about FoodLabs. They know about what topics we look into. They approach us, and then basically we act as a sparring partner, and then we
Mm-hmm.
decide together whether it makes sense to pursue that idea or not. So yeah, this is the best
Wow.
case. So to all founders out there, or soon to be founders, if you're looking to found something in that space, food, also health related to food, sustainability,
Mm-hmm.
climate, feel free to reach out to us or to reach out to me. Yeah, this
Wow,
is
that's super
this is
cool.
one
I've
way.
never heard of that before.
Yeah, it's a cool model, and I think it's a pretty unique model that we have here. And as mentioned, we actually started
Ah,
out at this venture as this venture builder,
yeah.
but then at the same time, we have the investment team, which I'm part of. So now I spoke quite a lot about venture building. I'm part of the investment team, where we do what's more typical or not typical, but basically what you would see with other venture capital funds, where we source deals, we analyze deals, and then we take an investment decision. But I
Hmm.
think what's cool about having these two teams, so firstly, it's a unique setup, and
Hmm.
secondly, obviously, both teams we work super closely together, and there are no clear lines or borders between the two teams. Like, if
Hmm.
there's a topic that I'm super excited about that is being built in our venture studio, then I can support our venture building team, but also vice versa. So if there's an investment topic that one of my colleagues from the studio team are excited about, and they're free to join on that investment opportunity. So we're kind of working together quite closely, and to an extent, it also helps because sometimes when we look into specific, market specific verticals, and we have the feeling that there is no cool company out there yet, we can give this information, or we obviously do give this information to our venture building team, and vice versa. They're actively screening the markets on a daily basis. So oftentimes they see companies that we have not seen yet, and then they would push them over to us. Um, so yeah, I think having this dual setup is quite cool and unique.
So, because you said like this is where you started out with, and you said a couple of times that this is unique. This is something you don't find at any VCs, or it's just super rare that someone would do that.
I would say it's super rare. I mean, obviously there's a good number of venture builders out there.
Yeah,
You know Y Combinator, you know Entrepreneur
yeah.
First, Antler. Like there's a lot of these venture builders out there.
I was actually
There's a
part of
lot.
one in Italy. It was called Vento.
Ah,
It
cool,
started last year, so I was part of the first cohort last year, and now they just finished the second one. And like, just for everyone to
cool.
understand what that means, they just hire or like recruit entrepreneurs. In my case, they had already like, it was less for people who already had a fixed idea,
Hmm.
um, but they would propose ideas where they either had a partner company that was like, hey, if you build something that solves that problem for us, we will invest in
Hmm.
you, or that would provide you with IP, or there was like VCs that said, hey, we can't find a company that does something like that.
Hmm.
Build something here. That's a good opportunity, and they might coach you through it, or
Hmm.
and then also give you like seed investment. So, like from this
How
side, that makes sense.
you said that was in Italy, right?
Yeah, it's in Italy, yeah, in Turin.
Cool, cool. How come, or like how did you end up going to Italy? Do you speak
um,
Italian?
so I learned Italian in high school, but that didn't really
Uh,
didn't really help me much anymore. And you use it or lose it, right? Especially with languages.
yeah.
But I was looking for. So I had made the decision a couple of months before finding out about the window that I want to use 1 year before starting grad school with
Hmm.
like just trying out business model, just also like first of all teaching myself to sit down without any like external driver of motivation
Hmm.
and just like sit down and do my own thing the whole week,
Hmm.
just to learn that, because I find that it's like one of the things that is really easily glossed over when people switch from university to entrepreneurship, or from like a full-time job to entrepreneurship. This switch to, okay, now it's just you, there is no one else asking you for or telling you there's a deadline, or there's no one else
Yeah.
who's like, oh, here's money if you come to work tomorrow. But it's just like
Mm.
this determination to sit down and do something for maybe a year, 2 3 years without getting any
Mm.
money from it. So I wanted to try out that, and second of all, just to try out some models and get some skills in trying to build
Cool.
tools, writing business plans, etc., etc.
Did,
Nothing of that worked out, but um,
I was about to ask, what was the outcome?
no. So in the end, I learned a lot. I learned a ton. I
Mhm.
tried out one thing with a friend of mine. Didn't work, or kind of like, let's say the initial data that led him to like pursue that idea turned out to be not false, but like there was some initial interest of clients that was just too small of a sample
Mhm.
size and kind of faked the enthusiasm, and
Yeah.
led us to make wrong hypotheses. Then the second one was actually about like more like on a production side. It
Mhm.
didn't work out in the end. And then I found out about Vento.
Yeah, I mean, you asked me before what my day to day looks like, and I did not answer on that yet. So as mentioned, there's not one day like the other in venture capital. I think this is what every person working in venture capital would tell you. I think you can, I mean, kind of break it down. Obviously, there's a lot of deal sourcing. So basically, looking for cool new deals out there and trying to find them before other funds find them. This is one big part. This can either work through uh, online research, especially in the early stages. It works quite well on LinkedIn. I'm many oftentimes just looking for people who put in their LinkedIn profile stealth founder #food. If people have something like this, I try to reach out. I try to get on a call, understand what they're working on. This sometimes works on websites like Crunchbase or Dealroom, although they're a bit less because usually startups that are listed on these websites are already out there, so they're then already a bit too big for us. But this also works through networking. You speak to other VCs that are kind of your age, or at least at a similar stage in terms of career. You speak with them, like either you get on calls, on like monthly calls, bi-monthly calls. You try to build a relationship with them. Of course, initially people are not going to share the hottest deals with you, but then it's pretty much about building a relationship with them and showing them that you share cool deals with them. That does not necessarily, have to lead into a positive investment decision every single deal that you share with them, but you just have to generally show that the kind of deals that you share with them, they're like cool deals, top-notch deals that are worth looking into. And by building these relationships, people start then sending deals back to you. So this is also a big part of the job, like connecting with people, meeting them for coffees, for lunches, having calls, but also meeting them at networking events. So this whole, yeah, absolutely, absolutely. I spend, I would say, I don't know, a big part of my day I spend speaking to people, either speaking to other investors or speaking to founders. So yeah, it's really about building up a network, reaching out to people, and yeah, speaking with people and trying to seize every opportunity there is out there to get new deal flow. So yeah, so this is the one side of my day, and then on the other hand, obviously, once there is an exciting deal that we decide to look into, um, I I start my analysis and looking into all the different um, specific topics that we look into there to basically come to an investment decision. These are obviously topics like the technology, the market, the competition, um, the investment round in general. I think one of the most important things, obviously, is the team, especially in a very early stage. This is, I guess, something that you would hear any early stage investor that exists out there. They would say the team is one of the main criteria, if not the main criteria, when it comes to making an investment decision at the early stages. So yeah, this is basically the second part, making the analysis of the topics that.
Quick question.
Mhm,
You hear quite
mhm,
often that in early stage investing, the most important factor is the founding team.
mhm,
But what does that mean? What are VCs actually looking for in a great founding team?
mhm. Um, I mean, again, there is probably not the one uh, wrong or right answer of what a team has to look like. I would say two big things that we like or that we look into is firstly that people kind of have industry or have industry experience in the space that they build in. This is, I mean, not all founders that build great companies have industry experience in that space, but I would say it helps a lot. Knowing the industry, understanding the industry, maybe already having a network in the industry. So this is one of the things that we look into, or in many cases have knowledge in the business model they're working in. So, for example, if I look into or if we look into marketplace companies, then it helps a lot if founders have worked for marketplaces before or even founded a marketplace before, just to really understand the dynamics of a specific business model. So it's these two things, and then I would say a great team is also a team with complementary skill set. So best case scenario is, or a very good scenario at least, is if you find a team where you have one person who has a really technical background. Um, Obviously, always depending a bit on the topic. If you build a consumer business, then you don't need a mechanical engineer. But people with a technical background and another person with a business background, so that basically kind of the founding team kind of brings in a complementary skill set, which is super important in the beginning. So yeah, I would say these are the main things that you can assess. And then of course it's also a lot about just seeing how the founders interact with each other, how they interact with us, how they react to, for example, data requests that we send them. Do they just not answer, or do they send back an amazing, set of answers a day or 2 days later? Like all of these minor things that you can't really assess in a quantitative way, but it's many of these things that you're just trying to understand throughout the interaction with the founders.
What documents should founders have ready before getting in touch with the VC?
Mhm.
Which ones are you
Yeah.
expecting? Which ones can they deliver after you ask for them? Like, what is
Mhm.
what are
Mhm.
the essential ones?
Mhm. So usually when founders first get in touch with us, or the other way around, we get in touch with founders, then I mean, obviously, it depends if they're currently fundraising or not. But let's assume the case that they're fundraising, they're looking for investment from a venture capital fund. Then usually the first thing that we request is a pitch deck, so a slide deck. I guess every startup out there has a pitch deck ready, or should have a pitch deck always ready. Because in many cases, even if you're not actively fundraising right now, investors might reach out to you, and you always want to have a deck ready because in many cases it's already, you want to build early relationships. If you're not fundraising but you start speaking to different funds that are proactively reaching out to you, then probably it's you would not deny them. You would speak to them, start building an early relationship, and then be in touch with them. So basically, it's a pitch deck. That's the first thing that we request, or that founders would send us. Based on that pitch deck, we decide whether we take a first call or not. I mean, it's obviously not only about the pitch deck, it's about the topic in general, whether it's something that we find exciting, something that we look into at the moment, something that, like a market that is not too crowded, something that is not conflicting with our portfolio. Basically, based on these criteria, we decide to take a first call. This first call usually is 30 minutes. Um, it's usually just myself and the founders, or one of my colleagues and the founders. And in this first call, you're trying to get a first understanding of the company that you're looking into. Um, in most cases, I try to pitch FoodLabs and pitch what we're doing and also how we can support them on their way. And then usually it's about them pitching what they're working on. This is usually like a 15, 20 minute pitch. So it's still, at the very scratching the surface kind of. Um, but yeah, so basically these 30 minutes initial call, first assessment, getting to know the founders getting to know us. And then after this first call, in most cases, you already have pretty much, you know, a feeling, or you can kind of say whether it makes sense to further pursue a specific company or not. And if that's the case, if we want to further pursue, then usually we schedule a second call. And starting with the second call, I'm asking one of my colleagues or in most cases, I'm asking one of my colleagues to basically join the call, because we always want to work on deals with two pairs of eyes looking into it. Then the second call, in most cases, also is slightly longer, usually between 45 minutes to an hour, where we also take a good amount of time to prepare for that second call in order to not only scratch the surface again, but basically go deeper and really ask the questions that matter for us to understand whether it again makes sense to further pursue this idea. And I would say usually after the second call, if we still decide we want to keep looking into the company, then the analysis phase starts, and there's not a typical path of this analysis phase. Usually, it's speaking to experts in the space, speaking to can be speaking to other companies out there. I'm speaking to a lot of portfolio founders if I have the feeling that they have specific knowledge about a topic that I'm looking into, which oftentimes is the case. So we're really trying to leverage the founders that are already in our portfolio. We're making our own market analysis. We're making our own competitor analysis. So yeah, it's pretty much all of that. Um, and whilst we do so, like if additional questions pop up, then we either send them to the founders, and they send us their answers back, or we set up another call. But usually we try to not take too much time of the founders in terms of calls. So yeah, and then yeah, I mean, it's everyone's aware that founders have other things to do than speaking with investors, and I mean, I never founded a company. I never even worked at a startup whilst they were fundraising. But I know from my experience here at FoodLabs from 1.5 years that fundraising is one of the most stressful experiences a founder has. So we're trying to be mindful of their time. They want to build a business, and they don't want to speak to investors that ask very high level questions. And yeah, so basically, sorry.
What funding duration, aka runway, do startups currently plan when raising money?
Yeah, I would say what companies are opting for now should be like runway of 18, 24 months, ideally 24 months. Um, times. I mean, I don't want to speak too much about what everyone reads on LinkedIn on a daily basis, but with the whole macroeconomic environment, times are not as easy nowadays as they were 1.5, 2 years ago when speaking about fundraising. And again, I mean, these are things. 2 years ago, I was not working, or I just started working in venture capital. So these are also just things that you hear and that people speak about and you read about. But basically, I think everyone out there knows that 2 years ago, or 3 years ago, in 2020, it was relatively easy compared to today to raise funds. And to attract venture capital funds, and to raise large rounds, and to have insane company valuations, basically pre-traction, pre-revenue, having being already yeah, two digit million valuations. So this is very different today. Um, and yeah, it's not as easy to get venture capital money anymore as it was back then. So usually, yeah, your runway should be 18, 24 months. And as you said, early stage founders should always be in fundraising mode, even if they're not actively raising. It always helps to be in touch with VCs, to speak early on, to update them on what they're working on.
Yeah.
Exactly.
When you say, just because actually I don't think I've ever talked with a VC about those different stages, but so like pre-seed, like right at the beginning, would basically be when you have a founding team and a slide deck, but not much else to show for, right?
Exactly. I mean, it's very hard to define all these different stages. I would say,
Yeah.
yeah,
Yeah.
it's very hard, and it's VC terms that I guess are hard to understand if you're not working with them on a daily basis. It's hard to define basically what pre-seed would mean. It basically is, as you say, founders that have an idea, that are already working maybe
Mhm.
on an MVP. Um,
Yeah.
they're not having nothing. Then that would be yeah, slightly early. But basically, it's founders with an idea, maybe working on some first things, conducting customer interviews, starting off. That would be pre-seed, and then seed usually would
Mhm.
be around a year, 1.5 years later, when you've already made some good progress. It's hard to tell if you're already expected to have revenue. This depends pretty much on the business model. I would say if you look into a software
Yeah.
business, B2B SaaS, to raise a seed round, and I'm not a B2B SaaS investor, so what I'm saying might be wrong, but from my understanding and what I hear from other investors, if you're looking to raise a seed round right now, building a B2B SaaS, then you should aim for around 1 million ARR. So basically 1 million annualized revenue to raise a seed round.
Oh, okay.
So basically make some progress. Might be slightly lower again. I'm not a B2B SaaS investor, but basically
Yeah,
these type of
but
companies,
somewhere
for
around
their
that.
seed round, they already have some traction. If you look into biotech companies,
Mhm.
then it would be about milestones they've reached in terms of R&D over the last 1.5 years. So basically the progress they're making when
Mhm.
it comes to developing their technology. So obviously for these biotech companies, no one expects to see any revenues after 1.5 years when they raise their seed round.
Yeah.
So it's different from business model to business model. And then again, the next round, Series A, probably again 1.5 years later. Again, depends pretty much on the progress you've made. Depending on the business model, either you manage to find product market fit and basically you manage to double or triple your revenues in comparison to the years before. With biotech companies, it's a bit more tricky to say whether they can already have revenues or not. This is something that's interesting to see at the moment. Biotech, food tech companies that are raising their Series A, obviously they do not have any revenue yet. And why do I say obviously? Because the majority of them are not allowed to sell their products yet because of regulatory reasons, especially in Europe. In US, there's just the first two companies that are allowed to sell, companies working on cell cultivation, but in Europe they're not allowed to sell yet. So there is no way that they have any revenue yet. And then you'd find some investors out there that are like, we really like what you're working on, but we can't invest because you don't make any revenue. So that's a bit difficult.
Okay.
Yeah.
Okay. Okay. So, and like, okay, then you get into the series, which again is like 1.5 years, 2 years from A to B. Like, I guess the investment cycles.
Yeah, exactly. Usually
grow. Okay.
18 months, you opt for 18 months, 24 months of runway when you raise a round. And this is also what investors would typically ask you. Like if they ask you what you're planning to spend the money on that they invest into you, usually you're speaking about a timeline of 18, 24 months.
Okay. And so how long, when you say you only do initial stage, like early stage investment, how long do you stay with a company, with a startup?
You mean how long basically we remain invested in that company? Or
yeah,
good question. I mean, I think that's very, very difficult to say or give you one right answer. Basically, so the running period of a typical venture capital fund usually is 10 years. So it's 4 years from closing the fund, usually where you deploy the money that you got from your LPs, so your limited partners, the companies investing in you as a fund. You deploy that money for 4 years, and then basically you have 6 years of running period where the companies that you invest in have further time to grow and raise follow-on rounds. And then usually after 10 years, you're trying to return the money to your LPs, basically the companies that invested in you, with the possibility, I think in most cases, to extend the fund life cycle by 2 years.
10 years?
Yeah. It's usually 10 years, the maximum, but obviously you exit some companies before. In the best case, either they get acquired by others, then obviously there's some companies go public, not the most common case, but also a way of exiting a company, being acquired. Then of course there is also the possibility, or an actually relatively high likelihood in early stage investing, that a company goes bankrupt. So that happens.
But you were saying that companies doing an IPO is not the most common way of exiting or being acquired, or
a company going public. I would say an acquisition. Acquisition is a very common way of exiting a company.
Often, right?
IPO.
Just wanted to clarify.
So I would say the most typical way of exiting a company is through an acquisition, merger and acquisition.
Yeah,
exactly.
Yeah. Okay, so just so I get that right, so when you raise money as a VC for that fund, it's like you go to companies, you're like, okay, we want to invest, like in your case, in FoodLabs case, you have a specific topic, like a specific domain that you invest in. So I guess it's more specialized, but let's say like a more generalistic, then they would say, okay, we raise that fund to investment in certain kinds of domains.
Exactly.
And then basically to your investors, giving the promise or the deal is, we're gonna give you the money back in 10 years from now.
Exactly.
Is it like we're gonna try to do our best, or is like a minimum of X interest, or how does
No,
that
I mean,
work?
usually you're trying to pitch your fund, not by saying we're giving your money back. Basically, you're trying to say we're trying to 4x, 5x your fund, for example, in early stage. So basically,
Gotcha.
returning 5 times the investment that you received 10 years ago. Um,
Hmm.
uh, to be honest, I'm not too much involved when it comes to fundraising from limited partners. So I
Yeah.
don't know. I guess there's nothing predefined, but this is how you pitch your fund. Um, Basically also based on historical data, what you managed to prove with your previous fund or funds. Um,
Yeah.
so yeah, this is what you're trying to pitch them. And as you say, we at FoodLabs, we're obviously pitching. Basically, the food industry is broken. The way we produce food is broken. By 2050, we're going to be 10 billion people living on this world, and there is no way of feeding all of them. By the way that we're producing food at the moment, so we have to solve this issue. Um,
Hmm.
it's a huge environmental issue. Food food makes a large amount of greenhouse gas emissions. So basically, we have it very easy to pitch this huge issue, and this is how we're pitching it to our potential
Hmm.
LPs. And yeah, and then we kind of also tell them obviously which geographies we're investing in, which stage we're investing in. This is also something that you're agreeing on upon. You're also agreeing on the maximum fund size that you're raising. So basically, the LPs that are investing into you, they
Okay.
know that, for example, you're targeting a. I'm not speaking about FoodLabs now. I'm just making something up. You're targeting a 450 million fund. And
Hmm.
then you also set a hard cap. Let's say this is you set a hard cap at 500 million. So your LPs kind of know what type of companies you're going to invest in, what your average ticket sizes are going to be when you invest. They're going to know which geographies you're going to invest in, um, all of that. So as a generalist fund, yeah, it's I guess it's still similar to what we are doing when it comes to fundraising. You try to show them what type of
Mm.
verticals, business models you're interested in, what stage.
Yeah. Okay. And then after those, okay, so basically, if you have 10 years, and every 1.5 years, so okay, so you raise the
Hmm.
money, you might have already some companies that already waiting for
Hmm.
investment, maybe lined
Hmm.
up, but it's a huge timing thing,
Yeah.
right? But then otherwise, you're also starting to analyze all the time, trying to look for companies you might invest
Hmm.
in, and then you have like one and a half, one and a half, one and a
Hmm.
half. So for you as an
Hmm.
entrepreneur, like for an entrepreneur, it would be when they talk to VC, a crucial piece of information is where in their cycle of their fund they are, right? Like,
In a way, yes. Um, in a way, yes. I mean, as mentioned, you have 10 years, and usually you deploy money for 4 years, and then you have 6 years, and the potential of extending it another 2 years, so potentially 8 years. So even if you receive
okay.
funding at the very end of deployment period, um, in theory, you still have 8 years to grow. But yeah, I do agree.
Huh.
Absolutely, it's like an important piece of information for the founders to understand where in the cycle a fund stands. Because of course, like if you receive funding at the very beginning of a life cycle, then you potentially might have the full 12 years to grow um, before you exit.
With that, then let's say you invest some like at the beginning, like in year
Hmm.
one. Does that then also mean you will stay with them for longer? Like, do you just stay?
No,
No,
not necessarily.
that's like
Again, there is
not
like
part of it.
in
Okay.
some cases, you stay with a company for, yeah, a longer period. In other cases, a company gets acquired
Yeah.
after 4 or 5 years. In many cases, a company files for insolvency after 1.5 years, 2 years. Um, so it's very hard to define
Mhm.
a
Yeah.
one typical way.
Okay. Then also, like, another question I have, because I really have no real idea how that works. Whenever a company or startup raises money, you always hear like that round was led by Goldman Sachs venture investing or Speed Invest or whatever. So how does it work in terms of like the company that leads the investment round versus the others that chip
Yeah.
in?
So at FoodLabs, we usually lead rounds or co-lead rounds. What that basically means is we would probably do the largest part of, we would invest the largest part of the round. So let's take 2 million, like a startup raises a 2 million pre-seed round, 2 million US dollars. Then the lead investor would probably, I mean, there are no predefined terms on or percentages on how much a lead investor has to do. But let's assume a 2 million US dollar round. Then we as lead investor would probably do 1.7, 1.8 million of that round. And then other investors would come in with the remaining parts, with the remaining bits, basically filling up the round. And this can either be other funds or business angels. And on top of that, I would say the lead investor, in a majority of cases, probably does the deepest analysis and due diligence. And then it's also the lead investor who discusses or negotiates the terms with the founders. And then basically the other investors, the followers, they invest on the terms that the lead investor agreed upon with the founders. So let's say, when you take an investment decision, we are super bullish on a company, we want to invest in a company, then we would make an offer to that company. We would tell them how much we're planning to invest or how much we would like to invest. And we also come in with a valuation that we're planning to, basically the value that we're giving this company. Then we're negotiating these terms. In most cases, there's some back and forth of negotiating the investment amount, the valuation, and once all of that is set, then the follow-on investors, or the followers in the round, they're basically joining the round on these terms. That's how it works in most cases.
Okay, so given that the lead investor sets terms and also invests somewhere along the lines of like 80-90% of the total funds, a lot of the people that otherwise invested, it sounds like, or at least I guess the way it plays out is that maybe the VC has some other business angels or know some, like within their network, where they're like, hey, this might be a cool opportunity, chime in there if you find a fit with the founders. Or like the founders have like some business angels that already have someone lined up who would like to become a small investor.
Exactly. That's the way it works, especially in the early stages when rounds are still relatively small. And in many cases, we're looking for business angels that we've been investing together with before, where we know, they bring in some knowledge. It's not just financial support that they're bringing in, but basically they're bringing in some domain expertise, some knowledge, a good network. So we like to work with them then. Or potentially also with other funds. This is oftentimes the case that you find funds with a strategy to only place follower tickets. So basically only, in these 2 million rounds, place tickets of 100, 150K. This also happens in many cases, that basically you work together with these kind of funds that have a slightly different strategy or that only do follower tickets.
Okay. Nice. So having, like, if you start raising as a startup, and possible advantage could be if you have some know-how rich angel investors lined up that could boost your pitch when it comes to finding a lead investor?
Yeah, absolutely. This is something that that can help a
Nice.
lot. If you have angel investors already invested in you, they can make intros. But also, if they're not invested in you yet, and you basically show the lead investor, look, we have these people who bring in a lot of domain expertise and who bring in an amazing network, and they would join the round if you decide to
Yeah.
invest. Obviously, this is a good signaling, and also something that would be considered positive. I mean, it's not gonna make or break a decision, but it's definitely something that is
Yeah.
that is a cool thing to have. And I mean, another thing that happens in many cases is basically these funds that only place follower tickets. Um, they always need
Yeah.
to find a lead in order to, you know, in order for the lead investor to invest around, so the follower can then basically follow the round. So this is also some very very beneficial interactions I have with these type of funds, because in many cases these funds would approach me with some cool startups that they've seen and that they've screened, and then they share these startups with me. Then we start looking into it, and then if we decide to make an investment into that startup, of course we would then ask the fund who showed us the deal to participate in the round as well, and basically place the follower ticket. So this is something that I would say is a very common thing.
Okay. Nice. That's really helpful information.
Great.
Yeah, I know that a lot of entrepreneurs that I know, that occasionally listening to the podcast, so
Cool.
I can see how that's really good info for all of them.
I hope so.
One more thing that I'm really just no, I guarantee you, they're gonna be happy. One more thing that I don't quite
Mhm.
understand yet. So when you go from one round to the
Mhm.
next, how does the whole investment, like your investment, basically, okay, the how much money you
Mhm.
invest given the percentage determines the valuation of the business.
In a
So
way,
next time when
in
the
a way. I
in a
mean,
way,
because
okay,
of course, initially, like at the very beginning, when we look into a company, it's very hard to put a valuation on that company, or
yeah,
putting a valuation that is based on any yeah calculations or any formulas. That's very difficult at a very early stage. Of course, there's if companies are a bit more advanced than others, then the valuation would be slightly higher, or if they manage to already show an MVP or a proof of concept or early traction, anything in this direction that would positively uh, this would have a positive effect on the valuation. But generally speaking, in the very beginning, as you mentioned, usually it's the amount that you invest and the percentage of shareholding that you want to get to that kind of brings you to a valuation. But then, of course, at the later stage, this is not the case anymore. Then there are some highly sophisticated ways of coming up with a company valuation. Um, I'm not investing post seed. So basically, definitely Series A, Series B growth stage investors can give you very detailed answers on how they come up with company valuations. There is certain ways to
okay,
do
okay,
so. I mean, obviously, in the end,
yeah,
in a typical venture capital investment round, the company is giving away around 20% of their shares. I would say this is uh, yeah, pretty
okay,
common. So this is also a way of determining always a bit the company valuation. If you look into the amount invested, basically for this is 20% worth of the company that you can basically come to a valuation. But that's actually not the sophisticated way, and it's not how it is done at later stage at growth stage companies. Then there obviously is very good ways of determining valuations.
okay. So how? What I don't understand is when you
Hmm.
invest in, let's say,
Hmm.
seed, but you won't invest in Series
Hmm.
A anymore. How do you do your calculation of how much money you might get out? Like when is it worth it for you going in? And also like who buys your shares? Is it then just like the next round that invests in your shares? Do you as an investor get to stay
Mhm.
in once the next round has happened, or do you have to chime in with new investment? How does it work?
So to the first part, like deciding how much money we invest, we're trying to understand how much money the company needs for the next 18 to 24 months.
Mm-hmm.
Of course, this is in many cases tough to say at the very beginning, but we expect companies to have like a slight idea of how much money they're going to need in order to achieve specific goals
Mm-hmm.
over the next 2 years, in order to make a
Yeah.
couple of hires, which is super important, obviously, in order to grow. So basically, this amount is something that yeah that the company tells us. This is then not a fixed amount. This can change. This can go up a bit. This can go down a bit. But this is a piece of information that usually the founders provide us with. And then
Mm-hmm.
it's very common to try to keep your pro rata in follow-on rounds. So what this means is basically,
Mm-hmm.
let's say we hold 20% in a company after we invested. Then in the next round,
Mm-hmm.
we can participate in the round, and we have rights in the majority of cases, or actually 100% of the cases. You're getting these rights. You agree on these rights and terms when you make an investment decision, that you have the right to invest pro rata in the next round. So this means, let's say we invest
Mm-hmm.
in a seed round, and then next round, Series A round, 1.5 years later, a lead investor is found. Then we are allowed to invest the amount that would allow us to basically keep the shareholding that we had in the company, so that we do not dilute too much. Um, and then, of course, once companies get bigger and the investments amount get higher and the valuations get higher, at some point we cannot keep our pro rata anymore. But this is what we usually try
Yeah.
in the very beginning, in order to not dilute too much, in order to keep our
Yeah.
shareholding as long as possible. But then, of course, later on, shareholding goes down, or you dilute. Um, and then you asked if we get to keep our shares. I mean, in some cases, it's common to do secondaries. So basically, that seed investor or Series A investor would sell their shares in the next round to new investors or new shareholders. This is an option, but you can. I mean, this is something, again, that's a very specific case, and something that is discussed on a deal by deal basis, um, if investors do secondaries or not.
Okay. Huh.
But
It's a complex
like in
system.
large rounds, that's oftentimes the case. So if you look at, let's say, a company that gets a seed investment, it's a 3 million round, and then the company performs
Mm-hmm.
super well, and then 1.5 years later, you know, new funds get in and you raise a 40-50 million round. I'm making something up here. I'm not talking about a real
Yeah.
example. I'm just making up some numbers. But then in many cases, basically the new investors coming in um, are buying secondaries from the seed investor. So this is also a way of exiting, actually, something that I've not mentioned before: selling your secondaries, or selling your shares as secondaries. I hope
Okay.
that makes sense.
Yeah, it does. It actually helps a lot because like the whole concept of diluting your shares, I was somewhat familiar with because you kind of
Hmm.
hear that from time to time. You also, I'm pretty sure the first time I heard about it was at the, this movie about Facebook,
Oh
the
yeah,
social network. I think it was
I
like
thought
a huge topic.
I,
So,
I thought you were gonna mention the entrepreneurship and innovation course that we did at university. Or did you do that actually?
I didn't
Oh,
do
okay,
E&I,
okay.
no.
I thought you were gonna mention that.
But how did they explain it to you there? Like,
Good
is it
question.
good? Like, is it useful?
I can't remember.
No, you don't
I
have to
can't
get into
remember
it.
to be honest. But I guess yeah.
Okay.
And I remember there was a specific course on private equity and venture capital, which I did not participate in, unfortunately.
Hmm.
Retrospectively, that would have
Okay.
been quite interesting. Um, but yeah, I did not participate back then.
Because you just mentioned private equity, like VCs. Okay, like the easiest way to explain someone what a VC is, I find, is from the perspective of like
Mhm,
risk. Like VCs compared
mhm,
to most other investors are much more or much less risk
mhm,
averse. So they do like high risk investments where the potential
mhm.
outcome is like huge, but the probability that it works out is just a lot
Exactly.
lower. So like if the people invest in shares, like they usually don't expect that 9 out of 10 companies they pick go to
Mhm.
zero. Um, but and one blows up,
But
but
then
they
the upside.
generally assume okay, some will lose in
Mhm,
value, some gain in value, exactly. But like with startups, given that a lot of them just don't
mhm,
exist anymore after a couple of years, you have that. Like, is there? So we talked about
mhm.
VCs and angels. Is there any other category of financial
Yeah.
investment
Um,
that you can get?
yeah, absolutely. And I think in many cases, um, maybe getting money from a venture capital fund is not necessarily even the right way. Not every startup or not
Mhm.
every early stage company um, uh, should opt for venture capital money. I mean, this is obviously easier said than done,
Yes.
but in many cases, and what we oftentimes see
Yes.
is that um, rock solid companies approach us. They're building a rock solid business. They show very
Yeah.
sustainable growth. If they manage to bootstrap, um, then why not
Yeah.
bootstrap? And in many cases, yeah, I mean, an exit might be even greater for a founder of a bootstrapped company that shows sustainable growth and then is sold for, let's say, yeah, a couple of million after a couple of years, and basically the founder
Yeah.
still holds the majority of shares, rather than a
Yeah.
founder that is raising money from a venture capital fund. Once the money is in, you're kind of pressured into growing your company and expanding your company. Of course,
Yeah.
it's not uh, growth at all costs anymore. This mentality that we've seen 2-3 years ago. But still, you're supposed to grow because for a VC, like VCs need to see substantial up rounds in order for the VC or in order for an investment to make sense for the VC. So this is something that we say in
Mhm.
many cases. VC money is not the only way to go when you're building a company. Um, but
Yeah. That's like just to clarify, because like I mean this is a second topic I would really love to
mhm,
talk to you about, because I personally feel like whenever talk like the talk about entrepreneurship almost seems synonymous with the talk about
mhm,
startups, whereas like startups being like high risk, high
mhm,
growth kind of models, whereas entrepreneurship applies to like so many different kind of
mhm,
businesses, as you just said, like rock solid businesses that just self finance themselves, then
mhm,
bootstrap themselves with their own money or their own revenue. But like just to clarify, so for high risk investment, basically the like for high risk investments for like high
mhm.
growth, the only two institutions out there, basically VCs and angels, that are like kind of like exclusively in terms of startups that raise a lot of money without um like within this model of like
I
venture
mean, and
backed startups
next
basically.
to the typical venture capital fund, you have corporate VCs, also a very common way. That
Corporate
Yeah,
VCs.
CVCs. So basically, corporates like Henkel has the big detergent company from Düsseldorf
Ah,
has a corporate VC
yeah.
investing. There is Porsche Ventures. There is I'm
Yeah.
pretty sure Procter and Gamble has a corporate venture capital arm. I spoke to a company from the
Yeah.
US today, General Mills. They have a corporate venture capital arm. I would say the majority
Hmm.
of big corporates out there, in the meantime, are quite active in venture investing and have their own teams doing so. Again, also a possibility, and in many cases, these corporates might be the ones that are acquiring you at some point. So also something to consider. I think the only important thing to
Mhm.
have in mind is that basically your vision for as a founder, your vision of a company might not align with the vision that a corporate has for you. So this is something to take into consideration
Mm.
when taking money from a corporate VC. Um,
Quick question. So for
mhm.
CVCs, is that then more often that they're interested in growing that company so they can later buy it? Or is it also from the perspective of just a profitable financial
That can be
investment
both.
that we can contribute with know-how
That
and
that
IP?
can be both cases.
Okay.
There's definitely both
Okay.
cases out there, and I would not say there is it's black and white for the majority of CVCs. In many cases, it's
Okay.
about bringing new technology as close to your company as possible in order to stay
Mm-hmm.
um, up to date with the latest technologies and potentially implementing into your um, conventional business as a corporate. Um, so it
Mm-hmm.
might be this strategic way of thinking, but it also might just be a pure financial investment. Although I would say, without knowing too much about corporate VCs, I would say the majority of them definitely would invest into businesses that are somehow close to their core business, which makes sense.
Mm. Okay.
But so getting back to the question,
Okay.
this is
Gotcha.
also a way of getting financing next to
Mm-hmm.
angels and venture capital. Um, then grants are a way. Um, we oftentimes
Yeah.
tell our companies to check grants. There's a lot of money out there from governments, from either from you the governments of each country or EU government. So there are grants out there. It's not easy to get them. Or in many cases, like it's a really tedious process. You have to go through a lot of applications. Sometimes it takes
Yeah.
quite a long time until your application for a grant goes through and you actually get the money. So I wouldn't say it's the only thing that a company can rely on, but definitely there is a lot of money out there and a lot of grants out there. So it's definitely also worth checking that. Then family offices are investing. In many cases, they do direct investments.
Mm-hmm.
So yeah, I
Mm-hmm.
would say that these are probably the most common ways. Of course, you can do crowdfunding, something that is also oftentimes
True.
overseen or overheard. Also a possibility to do crowdfunding. So yeah, I would say there's not only venture capital out there. There are different ways of getting money.
Yeah. Yeah. Like I find the discussion especially interesting when it's not how to put that. So the general premise I'm going off is that I observe lots of
Mhm,
people who want to become entrepreneurs only talk about startup
mhm,
entrepreneurship because that's what's in the newspapers, that's what's on social media. You rarely hear of companies that get funded with just
mhm.
crowdfunding and then have a super profitable company.
Yeah.
Like, I mean, you can go on Kickstarter, you can look at those projects. It's a
Mhm,
really cool product that are being launched that way or over similar sites. Like even the podcasting platform that we're using right now,
mhm,
Zencaster, they raised, so it wasn't Kickstarter, it was like kind of like a crowd. So it's like different, right? Like with Kickstarter, you don't get shares, you just buy a
mhm.
product and like give them the
Yeah.
revenue, like the money in advance, and then they produce it. They did like a different platform where they would just ask for a lot of people, like small amounts, and then they would just get, I don't know how you, it's also
Mhm,
crowdfunding, but I don't
mhm,
know if there's a word for that kind of specific investment. But so that
mhm,
works as well, right? And for them, that was, they had to get to at least proof of concept or already had like X amount of revenue, and then just hyper growth could like 5 times their
mhm.
team or 2 times their team by now, and probably even more in the
Yeah.
future, which is also a valid method. But it's I feel like where discussion is never really about is if you wanna be an entrepreneur in a certain field, the trade-offs between doing something super high risk with high growth, aka startup, or doing something that doesn't fall under the startup category is not a conversation that I really experience.
Yeah.
How do you feel about
No,
that?
I do agree. It's as you say, most people are speaking about, or I think you phrased it in a very nice way. Like entrepreneurship means hypergrowth, startup means raising money from venture capital funds, and
Hmm.
growing in a very fast way. Um, this is definitely what most people have in mind and what's most discussed. Um,
Yeah.
but I hear more and more people, and also yeah, close friends of mine saying now, I want to start a business, but I'm not really interested in starting something where I need to raise money every 1.5 years, where I need to speak to investors regularly, where investors put pressure on me to raise money. But I want to build a business, as you say, like something that maybe you can start with your what you've earned in your career so far. Maybe you can get a credit from a bank, and then you start something, and then you build something
Yeah.
that's profitable. Yeah, I think it's something that's maybe we see it less because it's not something that people really talk about, or not something that gets as much presence on social media, or on LinkedIn, on Twitter, or in podcasts, than businesses that have this hyper growth, um, or that are kind of hyper growth, and are raising a lot of money, and where all the big funds, European funds, US funds, invest in them. So maybe, yeah, they probably just have less of an online presence and are less spoken about because the stories might seem less exciting. Um, but yeah, in a way,
Yeah.
there are definitely many of them out there, and I think it's very reasonable to pursue a career like like this. And as mentioned, like sorry to
Would
interrupt, but as mentioned, in many
Mhm.
cases, the return for a founder might be, from a financial perspective, much better if you sell such a company where you still have the majority of shares, in comparison to when you sell a company where you only hold very little of shares anymore, and where you still, after like 6, 7, 8 years, you don't know whether you'll be able to exit that company, or whether it still uh, might have to file for insolvency.
so you would say it's in terms of like financial gain, like I mean, apart from the risk factor, like from the financial gain perspective, given that you lose so much of your shares throughout the funding process, it isn't necessarily that startups, even if like startup worked
hmm
out, say conventional business worked out, it's not guaranteed that the startup exit
I mean, I
results
would
in
say
more
it's
money.
very hard to give, again, to give like a definite answer on this
Yeah,
one.
general.
Um, but I would
Yeah,
say, let's say,
but both is
yeah,
possible.
it's definitely possible.
Yeah,
Because
yeah,
I mean, if you manage to sell your startup after you've raised a big chunk of money through various rounds, then definitely you're going to have a
yeah,
very nice exit. Um, but
yeah,
just because you raised large sums of money, and this can mean having raised three-digit million amounts,
yeah,
still then your company might not be profitable, right? If you're still aiming for that growth, and
yeah,
still aiming for that, and that might be after 5, 6 years. There has been a lot of money invested in that company, and still for some reason it might not work out, and you might end up with nothing, or being acquired for a very low valuation. So basically, being acquired for uh, yeah, a lower valuation than the previous round that you raised on, and then um, that might be an exit that is less attractive from a financial perspective for a founder, rather than
mhm,
when they, the same period of time, 5, 6 years, it's like 5, 6 years, build a business, growing that to, let's say, 1 million EBITDA. Then you sell that
mhm,
for potentially a couple of millions. Depends on the multiple that you get on your the EBITDA multiple that you get. But then and you hold the majority of shares, then
yeah,
that might be a very good exit for you.
Yeah, yeah. Um, this this might be a little hard to answer because obviously you are in a
Mhm.
VC, so you see that side, and probably didn't have much exposure to like conventional entrepreneurship. But have you come across like founders or teams? I'm not even saying ideas, but like really more from the people perspective, where you're like, okay, those guys, like from their mindset and also like from like the
Mhm.
skills, they might be it might not be the best idea for them to go into venture-backed startup space, but rather do something
Yeah.
in a conventional way.
I mean, you mentioned mindset and you mentioned skills. Skills definitely not, because
Yeah,
I would say um, building a business that basically is bootstrapped is as hard as building a venture venture backed business. And take,
but we say it takes the same skills as well.
I mean, this is very hard to say for me, having never founded a company myself. So take everything
Yes.
with a grain of salt.
Okay.
Um,
Yeah.
I would say the basic entrepreneurial mindset you have to bring is pretty much the same. Of course, it depends
Hmm.
on what you're building, but I would say skills wise, it's yeah, I would say it's probably pretty similar. But but as you said,
Hmm.
mindset, I think that's something um, where some people might have this hyper growth mindset. I want to build a 100 million-dollar revenue company. I want to start this here in Berlin, but best case in 3 years, I'm in the Silicon Valley, and basically the whole world uses my product. And there might be people that think
Yeah.
like this, and then there might be others that are happy to stay, or yeah, as we said, to grow their business in a more sustainable way, slower growth,
Yeah.
maybe not even having to expand to a different country. Maybe yes, maybe no, but not
Yeah.
necessarily. Um, so yeah, there might be people that have one or the other mindset. Um, yeah,
Okay. Hmm. Yeah. I can see that, and also there, it's like very important. Maybe they didn't have they didn't even have that idea or that knowledge to know that they could do it in a more conventional way as well, because they only had like the VC backed startup
I
route
mean, yeah,
in their
I
hand.
think in many cases, and I find it quite interesting that for these last 20 minutes, although I work in a VC, we're talking about how to build businesses without getting VC money. I find it quite interesting. Um, but I think in
I feel like because you see the see the line better, right? Like it takes someone who works in a VC because you see where it doesn't make sense for you to invest in. It doesn't it you see where it doesn't
yeah,
it's not a VC backed idea
yeah.
necessarily. So that's I really appreciate that right
No,
now.
but to get back to to your question, we've been at the very beginning of this podcast, we've been speaking about business schools and how everyone gets this mindset at some point, and basically you start hearing
Yeah.
about funds, you start hearing the cool stories about startups becoming unicorns, cool founders out there. There is zillions of podcasts out there of people speaking about these
Yeah.
topics. So I think if you start looking into entrepreneurship, like this is something that is just around you. That so
Yeah.
yeah, maybe in many cases this path of going down the VC way, or looking for VC money, attracting VC money, might be the most obvious one or the most talked about one. So yeah, maybe in many cases that's actually the case, that people don't really consider the other way.
Yeah. Damn.
Yeah,
Complex. complex thing.
Yeah, it's a complex thing. I mean, in many cases, probably it also you don't know in the beginning. There's many people out there that want to bootstrap a company or that manage to bootstrap a company for quite some time. They figure out what things work, what things don't work. They build a
Yeah,
proper product. They have first customers. They have good traction, and then at some point they're like, hey. We've done that now for 2 years, 2.5 years. We really know, we really found product market fit. We really know how things work. Let's go raise VC money now. Now that we know how things work, let's scale faster from here. Um, then
yeah.
from probably
That's
sorry.
no, no,
Oh,
go.
one other thing to mention, because we've been speaking about bootstrapping in such an easy way. For many people, it's not. It's not. From a financial perspective, basically
Yeah,
not everyone can say, "All right, I'm bootstrapping my company," because
yeah.
I don't know about you.
Mm.
I could bootstrap a company right now, because I think with my with
No,
my my current savings, I might have runway for 2.5 weeks. So
yeah, I couldn't have anyone on my payroll. Like myself, like scaling down, like I not even here, like you can't. In living in the Bay Area, you need so
yeah,
much money every month for your own cost of
yeah,
living. In Vienna, I feel like it would be possible going back into like a very small 300 euro a month apartment and
absolutely.
just buying groceries at Hofer.
Yeah, but that's
But
a good way.
like that also depends. Yeah, but it's tough. Yeah, I mean, obviously there are businesses where you can start. There are business models where you can start very small and then bootstrap it with the revenue you make. I've just had like the last episode I recorded with Dominic Sobe. He's like solo entrepreneur. He has developed a couple of web
Hmm.
apps so far all by himself. With the first one actually was until last year his most profitable one, and he has used that to pay like half of his life.
Hmm.
And now like his fourth application now really took off, and now he's yeah, he hit what the indie hackers call ramen profitability.
Okay,
So enough money to put a bowl of ramen in front of you every
nice.
day. No, but he really he can really live from
Yeah,
that. But it took a lot of
yeah,
time. It took a learning like a very broad skill
yeah.
set because if you can't hire other people, you have to
Hmm.
become this one man army of doing marketing, doing
Yeah.
sales, doing like some sorts of operations,
Hmm.
creating all those processes when you work with customers, be it B2B or B2C, plus building a whole
Yeah.
product. So there's all those things, and
You know,
yeah, it's hard.
someone probably really interesting for you to speak to, when you want to keep going on that conversation. I don't know, same name
Yeah,
like you, Jürgen Ulbrich. I'm pretty sure that you came across it
yeah,
at WU as well.
yeah.
Um,
I know him. Yeah,
this guy, I think he is currently building his second business without. I might be wrong here, but without raising any external money. Um,
they haven't so far. I had Patrick on,
mhm.
who's like his
True, of
something
course.
like a head of
Yeah, yeah, yeah,
operations.
true.
About the Günze,
Yeah,
yeah, we talked about that, but I haven't seen Jürgen since like right at the beginning when he started working on like they do like
yeah.
recruiting,
Sorry,
like
to mention.
alternative like recruiting channels. I don't why can't I think of
It's
the name right
spread,
now?
no?
I think it starts with
Spread.io.
S. Spread
Yeah,
exactly. Spread.io exactly. But yeah, yeah, definitely someone to talk
Jürgen, if you listen to this,
to about that.
if you listen to this, Jürgen, give us a like and join the
Reach
podcast.
out. Exactly. Yeah, it's a whole different conversation um, to have
Yeah,
bootstrapping. I mean, nice. To
yeah,
Nico, this was really great. I learned a lot. I'm sure the listeners will learn a lot as well. Do you want to give your contact for entrepreneurs that want to reach out, or maybe people who want to work for a
yeah.
VC? If it's okay for you to answer some questions,
Sure, absolutely.
or be
I
your
mean,
contact.
easiest way definitely to reach out to me is via LinkedIn. You find me under the name
Mhm.
Nicolaus. So basically Nicolaus. And then my surname is Norden, Norden. You find me on LinkedIn. I'm happy. Just send me a connection request. Maybe include a message. But usually I try to respond to everyone who's reaching out on LinkedIn. And then we can see where we take it from there. Always happy to jump on a call. Maybe this is something interesting to kind of mention as a last thing, for people who are also looking to join a venture capital fund. Basically, um, networking is super important already before being part of a fund. If you want to get into a fund, like, positions are fairly limited. It always makes sense to reach out to people who already work in funds, basically to connect with them, to ask them how they got in, basically maybe even benefiting from getting intros to other funds that are currently looking. This is also how I got my job, thanks to the people who helped me back then. This is how I ended up here. So that's a good way to get into a fund. So yeah, feel free to reach out as a founder, as an investor, as a student, as whoever you are. Reach out on LinkedIn, and happy to have a chat.
Nice. People should definitely make use of that, because, like, honestly, how much you helped me in those, like, understanding the whole space more. Like, that's an amazing resource to have. All right.
Glad to hear.
Thank you. Thanks a lot. And thank you everyone for listening. See you soon. Bye.